Hi, everyone, and welcome to Azzad Asset Management's mid-year market update. We're going to go ahead and get started in just a moment. As we wait for folks to come in, let me go ahead and share my screen with you. Okay, just a bit of housekeeping at the top. The webinar is being recorded, and folks should receive a copy of the presentation, a video recording, shortly after it debuts. Alrighty, and as we wait for our special guest to join us today, I will also mention that you can always visit azzadasset.com for other webinars and recordings of previous webinars. There's some good content in there. I think I see our guest has arrived. Just a moment. All right, I believe Christian Greiner has joined us. Christian, if you are there, please unmute your mic and say hello just so I can do a quick sound check and I'll get into the presentation.
All right, sound check. Are we
There we go.
pushed? All right, so let's see if we can get the video going here. All right, let's try that again. This is interesting. Why is it not picking up the video?
While you're doing that, Christian, I will go ahead and just do a quick intro just to give folks a level set, and I'll give you the opportunity to kind of troubleshoot that video issue. But
Yes.
yeah, take your time and feel free to hop back on mute. We won't need you for a couple slides here anyway.
Let's see.
But with that, I will welcome everyone to Azzad Asset Management's mid-year market update presentation. And just as an introduction, U.S. stock markets have in 2026, they've had a wild ride, continuing some of the turbulence we saw last year and influenced by major geopolitical events, economic policies, and shifting investor sentiment. There's Christian. Thank you for appearing. And while watching financial markets go up and down can be nerve-wracking, keep in mind that periods of market turmoil are normal and expected. That's why it's important to take that long-term view with investing and not let short-term market volatility distract you from your long-term financial goals. For example, retirement, wealth building, saving for college, etc. Staying invested for the long haul puts you in a good position to reach your goals, and the best way to combat fear of markets is with knowledge and understanding. And that's why we've asked our longtime large cap growth portfolio manager, Christian Greiner of Emerald Investments, to give us his professional observations about what happened and where we might be headed in the second half of the year. So your presenters, I've just mentioned Christian. Very quickly, I'm Josh Brockwell, Investment Communications Director at Azzad. I'm responsible for all things marketing and also spearhead our shareholder advocacy program. I will mention again, we are honored to have with us today Christian Greiner, Azzad Asset Management large cap growth portfolio manager. Christian is a longstanding Azzad equity portfolio manager with experience in market capitalization ranging from micro cap to large cap. He holds an MBA from the University of Chicago Booth School of Business and holds the Chartered Financial Analyst designation from the CFA Institute. Welcome again, Christian.
Thank you.
And as a reminder, we are a full-service financial planning advisory firm. Here's an overview of the services we provide on your screen now, from investment planning to tax and charitable planning to halal financial services. We've positioned ourselves at Azzad to be the leading provider of halal financial services in the United States. For those who may need a refresher, for nearly 3 decades, Azzad has been helping high-income professionals build their wealth in accordance with Islamic values. I will mention here very quickly that what makes Azzad different or unlike many other financial firms is the quality and nature of our advice, I believe. It's important to understand that that advice is centered around you and your family, driven by a higher purpose and designed to help give you peace of mind knowing your financial life is on track. With that, let's jump into the content for today. For those of you who have been with us in the past for these webinars, today may look a little different. Let me say that off the top. The agenda is to really lean into Christian's work as a stock picker and portfolio manager and let him run the show. We've heard your feedback from previous events. We appreciate your surveys and when you fill them out. And we know that it's hearing from the PMs, the portfolio managers, that make these events worth doing. So with that, let's turn it over to Christian for that expertise. Christian Greiner, over to you, sir.
Well, thank you, Josh. Thank you for the great introduction. As those that have been on these webinars before know, I usually like to start these reviews by kind of zooming out to get a little bit of perspective, especially in years like this where we've seen the volatility and regime shifts like what we have seen really just in these first 6 months. So this time I found this chart here to be most illustrative of what the U.S. large cap equity market's done over the last 3.5 years. Quite simply, you'd be really hard pressed to find such a streak of sustained success like what we've seen from pretty much those autumn 2022 lows. So in that time, we've weathered inflation scares, shifts in fiscal policy and monetary policy, tariff shocks, global political instability, and as we are seeing right now, a sea change in how we're interacting with technology. So over that time frame, patience by the investors have really been rewarded as these outsized concerns really happened against a relatively benign domestic economic backdrop. So in any market, there's winners and losers. And what we've seen lately is that the larger companies within the index have been growing their profits at a much faster clip than smaller counterparts and reinvesting these profits into consistently strong investment ideas. And we've seen that in investment returns over, say, the last decade, where large caps have really outperformed. And the result is that the largest 10% of US stocks, by count here, now make up a bigger share of the market than they really ever have in modern market history. The caveat that I always like to use when you see graphs like this is that we have less publicly traded companies than we have in the past. Still, this level of concentration, it does bring a certain amount of risk to investors. But as we can see here from this chart, as it goes up and down, periods when this concentration has spiked have been followed where that concentration, it goes down. This could happen whether these large cap stocks just plain out underperform, or if we see a period where these larger stocks kind of hold their level and we see sustained outperformance by their smaller peers. We've seen signs of this broadening of returns over the last 9 months or so, as small caps and mid caps have outperformed their larger peers, and the most famous of these large cap stocks, the Mag 7, have underperformed the S&P 500. So with all that in mind, let's zoom back into where we are at this halfway point for 2026 here. It's kind of with this market dashboard. And the broader equity market is toying with the idea of a fourth straight year of double-digit positive percent returns. Prior to this, the index has really only had three double-digit positive return years in a row, just really three times in its 95-year history. What's flipped the script a little from where these returns are, where they are really coming from, and value has taken the reins from growth after a long period of underperformance. And we saw this after a particularly strong first quarter performance for value during a market sell-off. Mid and small cap stocks are also outperforming their larger peers for a change as returns broaden out a bit. Remember, at the last one of these that we did, we were looking for that. And looking outside the US, international stocks are also faring better, particularly emerging markets, which have really lagged over the last decade or so. So staying on that topic of change, we can also see that the Mag 7 have effectively flat performance for the start of the year, while the rest of the S&P 500, the other 493 stocks, if you will, have returned 15%. The broad S&P remains above its long-term historical average on every valuation metric. That price to earnings ratio, the PE ratio, is based on projected earnings for the next 12 months. And that's come down as earnings growth projections have risen. But the long-term cyclically adjusted PE, also known as the Shiller's PE, is trading way above its average. And the earnings yield that an investor gets over a BAA rated corporate bond is negative. Usually that should be positive given the additional risk from owning an equity. So when we see that these valuations are at these elevated levels, there's often the temptation to ask the question, are we at the market peak? When is this market peak? And taking a look at one of these most long-term indicators, that Shiller's PE, that cyclically adjusted PE ratio, we can see why these questions might be popping up. The cyclically adjusted PE, just as a reminder, measures price levels versus the last 10 years worth of corporate profits. And that really captures a market cycle or two, rather than just a point of time indicator, which really could be distorted by where we are in the market cycle. And we can see that this indicator is currently near past market peaks. And the next 10 years inflation adjusted returns from those peaks, as you can see, are not particularly impressive. So this may serve as one marker of caution for us, but this is a long-term measure with many peaks and valleys, not really meant to time markets. And there are opportunities to be had in any market for long-term investors. And as we've seen over the last few years, market valuations can stay significantly above their long-term averages for an extended period of time, with stock prices continuing to climb. So let's take a closer look at what has driven the returns of the S&P 500, the most well-known U.S. large cap benchmark. It returned 10.2% for the first 6 months of the year, a pretty healthy return. And these returns are driven by a couple things. The earnings that these companies produce, which is a product of the revenue that they make, and the profit margin that they achieve on those earnings. And this earnings growth could be further enhanced by share buybacks. The less shares there are, after all, the more profits there are for the remaining shares. How the market sees the prospects of these future profits are often reflected by the PE ratio, the price to earnings ratio. A PE can go down if the price goes down and the earnings remain the same, or if earnings grow faster than the price does. And that's kind of what we're seeing right now. The change in the EPS and the PE will give us the price returns, add on any dividends that you might receive from a stock, and you get the total return for a stock or a sector. And what we can see with these returns is that for the first 6 months of the year, well, it may surprise some people. The best performing sector has been the industrial sector. And some of the best performing companies this year have been those that help construct the data centers that will house the computing power that will enable AI. They make the bulldozers that clear the land, the racks that hold the servers, and the cooling systems and power infrastructure that ensures uninterrupted service. The tech sector, as we can see, was close behind, with semiconductors and memory stocks having a really good year, while software has lagged their peers. On the downside, at the bottom there, you can see has been the consumer discretionary and financial sectors. Both of these have been hurt by near-term fears about the economy and the consumer, and as well as interest rates. So one of the greatest sources of optimism for this market, and really concern as well, has been the level of optimism that's been going into the earnings estimates that drive some of those forward PEs. S&P 500 profit margins are about as high as they have been really ever in the last 30, 35 years, and are expected to rise even further over the next year or two. And there are a couple reasons for this. Companies are starting to see higher returns for the implementation of technology, uh, optimizing their supply chains, as well as their staffing levels. Wage pressures have subsidized, I'm sorry, subsided from years past. All of this comes against a backdrop of steady economic growth, as we were talking about earlier, in almost all geographies, not just the US. So far, most companies have been able to pass on the input price increases to customers with minimal pushback as well. So the analysts really can't seem to raise their future price estimates quick enough to reflect these realities as the companies are bringing their earnings to light. We can see going into second quarter earnings season, which started this week, that the consensus earnings were about as rosy as we have seen coming out of since coming out of the pandemic or surrounding those tax cuts that occurred during 2018. If these estimates prove to be true, this will be the second consecutive quarter of year-to-year earnings growth of over 20% and the seventh consecutive quarter of double-digit earnings growth, which is quite impressive. So there's a lot going on with this slide, but I really think that this shines a light on this earnings growth that we've been talking about and the expectations of that further growth. The graph on the right shows how these earnings expectations have been revised higher. Historically, this pattern usually is that these earning estimates start out too optimistic and then get rolled back on earnings misses when companies report reduced guidance, and analysts realizing that just some of these profits that they put into their models aren't going to materialize this year. Only about 20% of calendar years see what we're seeing now in 2026, with earnings expectations building momentum as the year goes along, moving higher. The years we see this kind of pattern are often years coming out of recessions, when analysts are overly skeptical or pessimistic on future prospects and start raising estimates as a recovery becomes a little bit more credible. From what we've seen in terms of sectors driving this earnings growth in 2026, it's broad-based, with no sector really seeing a decline for 2026, but some definite laggards in the more defensive areas of the market. Economically sensitive cyclical stocks are faring a lot better. Within the tech sector, the spread is even more pronounced. Semiconductor stocks are pretty much projecting a doubling in year-over-year profits, while software profits are only growing by 18%, which in most years would be considered pretty impressive. Uh, so 2027 is seeing a similar dynamic with earnings growth revisions also rising at an even faster clip. The question is, what could slow these estimates down? And what would that do to future valuations? We'll look at that in a couple minutes. After all, markets are forward-looking mechanisms. A slowdown in these growth rates could reduce the multiple that market participants are willing to put on these future earnings. So let's turn to a subject that really is on everybody's mind, artificial intelligence. And this has really captured the public's imagination, as we have all seen from the headlines, for better or for worse. But it's also really captured that of the business community as CEOs and CFOs detail their plans to implement the technology and how it's affecting their business plans and bottom lines, and as well as their headcounts. Almost every earnings call transcript that I've read this year has mentioned artificial intelligence. You can see examples of non-tech firms using AI to optimize inventory and staffing levels. You can see real estate firms streamlining their listing processes, insurers cutting underwriting costs, and even coffee giants helping customers design a drink in their apps through use of words or a photo. So I used this graphic on the right last year on this same call to illustrate the adoption process by industry. And just to illustrate that rate of change, the total a year ago was 9%. It's now 21%, with every industry seeing some form of increased adoption, but still some more room to grow. So from our perspective as investors, we have to ask ourselves, where are long-term profits? Where are they going to be coming from for a lot of these companies? And just as a reminder, free cash flows are often one of the best markers of a firm's long-term profitability. After what a company makes from selling goods and services and what it has to spend on capital expenditures to keep that business going, free cash flow measures what a management team think it can do to further expand the business through internal or external projects, through mergers and acquisitions, or return capital to shareholders through dividends or buybacks. So for a long time, hyperscalers were throwing off cash as their cloud and compute businesses enjoyed rapid growth. However, as we've seen over the past couple of years, they've had to invest massive amounts to build out new servers to increase capacity, containing highly advanced processing chips to keep up with more complex demand, and their competitors as well, and invest in data centers and power supply. All of this means that the capex to keep these businesses going has increased, greatly reducing those free cash flows, as we can see from this chart. And what we have seen is that these companies, they're coming to market with these huge debt issues, and others sell stock to fund these projects. We've already seen some analysts push back on the profitability projections and timelines for some of these companies. So the big question will be, when will the free cash flow profiles of these companies improve after this spending boom? And where will possible expense cuts come from if they need to happen? So stocks related to artificial intelligence, they haven't been trading in lockstep, and no matter what it seems like on a day-to-day basis. Instead, we've seen this trade take certain waves. The first of these were the hyperscalers whose compute capacity was used to fulfill requests from various platforms. The second were these chips that were being used to build out the capacity. They became tight in supply and more complex in technology, and we've seen these semiconductor stocks and these chip makers really take off because of that. The third was a recognition of the power infrastructure needed for all of these data centers. Everything from the engineering services to build these out, to the manufacturers of the rack and cooling systems, to actually the power companies themselves. We've seen some rally in the utility sector. So the last that we are really seeing here in 2026, the latest one of them, is recognition of the memory needed, sparking a rally in areas of the tech hardware and semiconductor space that frankly has just lagged over the last couple of years, kind of forgotten area. The prices of memory have spiked, and projections for shortages for some advanced areas of the memory market are going out to 2028. On the other hand, one of the most visible victims, if you can call them that, of the AI revolution have been software companies. And the fear here is that AI will help companies design their own tools, or at least limit the number of seats on existing software platforms that they're currently using as productivity increases per employee. And we saw this happen early in July as Starbucks detailed their plans to design more software in-house, and that caused a decline in two particular software bellwethers. So these fears have led to a bear market in the software industry. You can see that software is down about 20% on this chart here. And with aggregate industry returns being down 20%, we've seen some winners and losers within that number, as some security software and AI-oriented names have been bid up. And when we think about it, it would make sense that not all of these artificial intelligence exposed companies would trade in lockstep. After all, a lot of them are in direct competition with each other. And some serve as suppliers and customers of each other. And the second quarter of 2026 showed us an example of what may come with the interplay between these industries. Hyperscalers broadly underperform the semiconductor chip companies whose products go into the servers that drive these AI request queries and computations. These two have pretty much traded in line before. However, in second quarter, concerns about how much these companies can charge for this capacity have really come to the forefront. Indeed, we've seen concerns that some are going to compete on innovation and performance, while others have announced their intention on competing on price, undercutting rival enterprise models by 75% in an attempt to get the workflow of less advanced tasks. So the question is how soon before these hyperscalers that they further start pushing back on these chip suppliers to get these price concessions and recapture some of these profit margins, not only quarter by quarter, but in the long term. Already, we've seen some hyperscalers deploy custom AI silicon solutions, shifting away from higher memory costs and cutting their infrastructure costs by 30 to 40%. And after all, AI is going to be like any other industry. As innovation diffuses out, the focus will come to who can provide quality at a cheaper price. We've seen some users shift to less expensive models, rationalize costs, set token budgets, and we've seen AI models shift their pricing structure to reflect this reality. And of course, one of the biggest points of contention about the promise of artificial intelligence comes from the assumption that the benefits to these companies will be cost savings in the form of reduced headcounts. And we've all seen the headlines about thousands of people being laid off at some of the world's largest tech firms with artificial intelligence and their demonstrated efficiencies being seen as the culprit. And what we can see in these two charts is kind of a different picture. Over the last year, software development job postings have gone up at a rate much faster than the broader job market, at least at one prominent job site. And we can see from the second chart that companies with a higher AI adoption rate, and these aren't just tech firms, seem to be increasing headcount at an aggregate rate higher than those of their low AI adoption peers. And one other note, we've also seen some companies push back on AI usage, rationalizing the costs already, as a couple of prominent companies have talked about how their employees have already blown through their token budgets or their AI usage budgets this year. And we can see that over the next couple of years, employees that can build the best tools utilizing artificial intelligence in a cost-effective basis will really be in high demand at companies, no matter what the industry, as they continue to optimize that mix of technology and human capital, just really as companies have over the last century. So with that being said about AI, I'd like to go back and take a look at some of the things that might have been, seen as more of classic concerns about the market. And let's touch on the one that we really talked about last year, and that's tariffs. Tariffs have faded from the front page headlines. In February, the U.S. Supreme Court ruled that the International Emergency Economic Powers Act does not authorize the president to impose tariffs. And so that's caused sort of a slow-moving flow of past tariffs to go back to the affected companies, which should theoretically go back to the consumer. At what level remains to be seen, though. As of the start of July, the US government has refunded about 40% of the emergency tariffs charged. This could serve as something that slightly cools inflation over the coming quarters. Still, what we can see here from this chart is that the baseline tariff rates on imports are going to be higher than what we've experienced over the past decades. And although these stated rates will sometimes be higher than what is actually paid after exceptions and other possible loopholes, there's still a couple more court cases coming up to watch out for. But this is a situation that still bears watching, especially if economic global growth starts to slow, which usually causes countries to grow more protectionist and put measures like this in place. And as you know, I keep a close eye on the US consumer. After all, they drive about 70% of GDP activity when all is said and done. And recently, as the financial press will tell you, the consumer is in a really bad mood. This comes despite the unemployment rate being below the long-term historical average and nominal wage growth being slightly above the long-term average as well. The issue might be the effects of inflation. And as inflation, as according to the former Fed chairman's favorite measure, starts outpacing that nominal wage growth, the consumer's going to feel it. And that is what we're seeing here, as that real wage growth has turned negative again, much like it did after COVID when inflation was the paramount political concern. Uh, the expectation is that this real wage growth, and it will be negative for the next couple of quarters as higher energy and other input prices work their way through the system and wage growth remains tepid. So this chart here best illustrates why we watch the consumer and how they feel about their prospects, as well as those of the economy so closely. In the past, when consumer confidence bottoms, it's a good time to get into stocks, specifically large cap ones. On the other side of the coin, once it gets too buoyant, it serves as a warning sign that the next 12 months returns might be flat to slightly negative. The University of Michigan Consumer Sentiment Index is a closely watched barometer, and it's near its past bottom levels. The current situation is curious because consumer confidence is so low despite unemployment being below its historical averages and financial assets hitting their peak, creating a strong wealth effect for some consumers. The pessimism seems to be a function of two things: those high inflation expectations that we were talking about, but also future prospects, be it about housing market or a consumer's long-term employment. And it seems like the majority of wage earning Americans are feeling this in the form of slowing average hourly earnings growth, as seen on the chart on the right here. The left chart shows a concern for some economists and market historians. Labor is getting close to the lowest share of national income that they have received, all while corporate profit margins reach all-time highs. And we've seen this share fluctuate in the past. Think about the time after COVID that saw a lot of job switching with a concurrent rise in wages as companies took steps to attract and retain talent. However, with the current national conversation around AI and the pinch of rising inflation and the memory of larger raises fading into the rear view, that can explain a lot of the national conversation about an economy where the winners are doing better than ever before, and other participants seem to be struggling to tread water. While the investments made by businesses to grow their infrastructure have been a nice tailwind to GDP for the last 6 to 8 quarters, sooner or later, one's going to expect that we're going to need to see credible expected wage growth to drive higher economic growth rates. And so this is what has caused this K-shaped economy that everybody has talked about, these feelings that there are two paths here. And, with that happening, as I said, this is something that we have to really keep an eye on here. But one question I also hear a lot from investors is that if this market is following the same pattern that it did during the first internet bubble. And if so, what year is it? I.e., are we still early with years left to run, or are we near the peaks? And charts like this here, they make for eye-catching conversation starters, and you'll see different forms of them. While this time is different, is cited as really the four most expensive words in the stock market. A quick reminder, none of us know when a market's peaked until well after the fact. What we can do is we can take a look at similarities and differences in past rallies and markets. And unlike the 1990s, the profitability and cash flow metrics of a lot of the companies driving this rally are a lot stronger. They're in better shape. They have better cash flows, free cash flows, and net profit margins. And the market multiples aren't as high as they were at the peaks. Remember, we're taking a look at forward PEs in the low 20s. In the late 90s, that was about 25 or 26 as a peak. So while it's similar in the same amount of companies accounting for the lion's share of the stock market's total return. And that's something we're going to touch on in a little bit. There's also some pretty ebullient long-term profit projections that go into these forecasts, and that bears watching as well. So now we'll turn into something that is always kind of a concern, and that's the Fed. We have a new Federal Reserve Chairman, with Kevin Warsh being installed in May, and previous Fed Chairman Jerome Powell kind of really breaking precedent here and seems intent to serve out the rest of his term as a Fed governor through January 2028. And like with any other Fed chairman, market watchers will be eager to learn Warsh's preferred measure of taking a look at labor health and inflation and reflecting really the dual mandate of the Fed. And as a reminder, that is maximum employment as well as stable prices. And right now, it looks like the maximum employment part of that mandate will be taking a backseat to the stable part, the stable prices. In terms of the Fed's priorities, at the start of the year, markets were pricing in two rate cuts in the closely watched Fed funds rate due to concerns over a weakening labor market. As inflation measures started to tick higher, the expectations have shifted to markets pricing in a rate hike by the end of 2026, with a 1 in 4 chance of that happening in a July meeting, and about a 50-50 chance of that happening in the September meeting. Uh, this is illustrated by this chart here, where several academic models of where the Fed funds rate should be, given current inflation, employment, and market conditions, all show that right now, maybe the current rate is a touch too low. So complicating all of this is that the new chairman has expressed that less is more in terms of Federal Reserve communications and seems intent on rolling back some of the measure of transparency and communication that has been the norm going back for really the last 15 years. And that might include Fed members speaking less frequently and pulling back some of the forward guidance, including the ever popular dot plots, which illustrate members' views on where rates should be in both the short and long term. These charts here touch on concerns that some market participants have as the rally continues, and this kind of deals with the mechanics of the market. The first of these involve ETFs, exchange traded funds, dedicated to levered returns on single stocks, where you get the return, for better or for worse, of a single stock at a 2 times, 3 times, or whatever the leverage is. Each day, like any other ETF, they have to buy or sell shares depending on how much investor demand there is for that ETF. This leverage and dynamic could cause greater flows and make moves in certain stocks more volatile on a day-to-day basis. The second of these is the return of IPOs. Kind of reminds us of those days of the tech market in the 1990s. As we touched on before, the number of public companies has been dwindling as some of the large companies, frankly, they stay private for longer. We've seen a couple highly anticipated IPOs hit the market this year, and a couple more are expected by the end of 2026 or maybe the start of 2027. As investors clamor to put these shares into their portfolios, and as major stock indices bring these companies in quicker than we really ever have before, this can cause some increased volatility as in these new companies as well as some of the older ones. And this is before we even take into account what might happen after the lockup for some of these IPOs expire, and certain shareholders can start selling their shares on the open market. And the last cause of concern that I'd like to cite is that this has been an extremely price momentum driven market, at least at the moment, showing a similar dynamic to what we saw tech stocks do in the late 1990s. While price momentum is a factor that needs to be taken into account for market returns, it can often overheat like any other factor. Quality can overheat as well can value or projected earnings growth. The question is that once some of these high price momentum stocks they cool off, what will take over market leadership in terms of keeping prices at these levels, or could they go even higher? Which sectors are going to take leadership in the next leg of this market? And so, in closing, I often like to take a look and remember that even over a decade, the makeup of the drivers of an index can really change drastically, even if it doesn't feel like it on a day-to-day or a year-to-year basis. And what I illustrated here is what are the top 10 holdings of the index going back to the start of 2015 to what they were at July 1st, 2026. And as you can see, only two of the top 10 companies in the S&P 500 at the start of 2015 are still there at this point in 2026. GE is now three different publicly traded companies, and J&J will be doing, Johnson Johnson will be doing the same thing after they spin off another company at the end of this year. We can also see that the total weight of these top 10 companies is over uh, double of what it was back then. And they've gone up over sevenfold in terms of market cap. Once again, illustrating how large some of these companies have become at the top of the market. This also serves as a reminder that odds are the next 10 years are going to bring just of a drastic of a change. Present day market darlings are going to come back to earth, and they're going to be replaced by others that bring innovative goods and services to the marketplace. This is a dynamic market, and it's going to present unique opportunities and challenges to investors. And while day-to-day headlines can be daunting to try to keep up with, it's good to keep an eye on the long-term perspective of the economy, as well as these companies that are bringing these innovations to the general public. So we will be keeping an eye on these opportunities as well as these risks that we've talked about here today. And to sound like a broken record, these are exciting times. And as usual, if you have any questions, we're always happy to try to help answer them as best as we can.
Thank you, Christian. Appreciate that perspective. That was really great. And obviously, love your insights, everything from AI to tariffs to the K-shaped economy. You kind of touched on it all there. And I think that our audience benefited from that today. And as a capper to your talk, though, I would like to put today's presentation in context for investors of all stripes. And first, let's just remember that Christian is a professional who manages your money for you. His job is to find opportunities for clients, and your job as a client is to let him do that. One of the most frequent pieces of counsel that we offer our clients is to stay invested, even when times are turbulent. Investors forget that the cost they must pay for potentially higher long-term returns is that short-term market volatility, like the kind we saw in the first half of 2026 and going back even 2025. They think they can get out and in the markets without any consequences, and that's a very dangerous misconception. When you get out, you will most likely need more time, and your investments will need to work even harder than if you had just stayed in to begin with. So don't try to time the markets. No one knows the perfect time to get in and out. What a lot of investors get wrong is that equities or stocks accumulate most of their gains over just a few trading days. If you miss those trading days, you'll be left behind. You see there on your screen now. We know that missing a handful of the best days over longer time periods drastically reduces the average annual return you could gain by simply hanging on, holding on to your investments during those market downturns or sell-offs. Avoiding the market's downs may mean missing out on the ups as well. 78% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. If you miss the market's 10 best days over the past 30 years, your returns would have been cut in half. And missing the best 30 days would have reduced your returns by an astonishing 83%, as you see on your screen there. So in short, the lesson here is that it's time in the markets rather than timing the markets that will help you grow your wealth longer term. So let the pros like Christian and the many other Azzad portfolio managers who work on strategies do their jobs. So once you've got a plan, stick with it. Last but not least, we also want to take this opportunity to inform you about our on-demand webinars. A few of the most recent and most popular ones are on your screen right now. Please be on the lookout for more information about future live webinars in the near future. And that will conclude today's presentation. I'd like to thank all of you who took the time to be here live with us today. If you'd like more information, please do reach out to us. The email address is hello@azzadasset.com. And in the meantime, be sure to follow us on social media. The handle for our Facebook and YouTube accounts is @Azzad Funds. You can find us on LinkedIn and Instagram. That's new, under our full name, Azzad Asset Management. Thank you so much for your time today. And thank you, Christian, again, for all of your expertise and joining us. Always a pleasure.
My pleasure as well.